Hey guys, what's up? This is Tony from alphapursuits.com. In this video, I'm going to talk about why I do not like gambling. So you're probably laughing right now because options trading, some people think it's gambling. In fact, a very dangerous way of gambling your money, which I actually strongly disagree, and I'm going to show you why that is the case. So here's a calculator that I created using a spreadsheet, and let's talk about flipping coin. And you bet on head or tail, and normally, unless the coin is rigged, it should have a 50-50% chance of getting head and tail. So when if the payout is the same, and in this case, let's say, $500 if you lose, $500 if you win. So $500 if it's tail, $500 if it's head. And with a 50% chance, if you do this for hundreds or thousands of times, in theory, you should be getting your money back, right? Because you have 50% chance of winning and losing. So you might win 3 times in a row, but then there's a 50% chance for you to lose 3 times in a row. So you get the idea here. So flipping coin isn't really a gambling, so to speak, right? It's sort of a luck that you're trying to test yourself, but mathematically, you should break even in the long term. So the way this calculator is set up is based on that concept. 50% chance. And so if you have at least a 50% chance of winning and losing, then it gives you a good trade because at least you are not going to lose your money. Now let's talk about roulette, in casino. And this also applies to any kind of games in casino, really. They really figured out a way for the house to win and for you to lose money when you play again and again for long term, basically. So how roulette works is that, let me show you a picture here of the roulette. So basically you will bet your money on, either based on the numbers or based on the color. And the easiest way to demonstrate this is really use the color. So, red and black. So there's a 50% chance for you to get red and black if this 0 and 00 don't exist. Now they put this 0 and 00 in there and to skew that probability of not being 50-50. So it basically, the house casino is going to win more likely compared to you winning by adding the 0 and 00 in there, because it completely is basically not completely, but skews the 50% chance a little bit. So this is essentially, a gambling, so to speak, right? Because you're betting, you're putting your money in there, and it's a truly luck. You're betting on luck, but mathematically speaking, you are not. You're gonna lose if you do this thousands of times. So if you win a few times, you should just get out and stop playing. And slot machine, same kind of deal. They already figured out how many times you play. They're gonna let you win. So there's really no point. It's purely for entertainment if you want to go and play those kind of games. Now coming back to the calculator. Let's talk about options trading here, and I can actually show you some examples on why, based on the setup, you're more likely to win if you keep repeating the setup for hundreds or thousands of times. Okay, so let me show you how what we just talked about can be translated into options trading. So here is a credit call spread for December expiration, as you can see, and the probability of being break even at expiration, which is December 20, is about 34%, as you can see on the screen right there. Well, let's use the calculator and see what happens. So 680 is the amount that you're going to lose if you get it wrong. 320 is the amount we're gonna win if we get it right. So 320 and 680, and probability of losing is 34. And obviously, this is not a good trade, because if we do this thousands of times, we are going to lose money. That's the way that's what this is telling us. So the break even really is 32%. And so the next question is, would I not trade it? Well, not necessarily. I mean, this numbers is on some historical data, and it's obviously not the entire historical data. It's probably just what last year, and then Thinkorswim does the calculation and then give us this probability of saying, okay, this is likely what's going to happen in December. So it's not 100% accurate, but it sort of give us a gauge of, okay, this is the risk and return. On top of that, there are also other factors, right? One being, okay, right now it's almost it's really close to the all-time high. And looking at some indicators, we can see, okay, it's probably overbought. It's likely going to turn pretty soon, and things like that. So you can incorporate some other data into the calculation. And let me show you another different setup here. And this is also how this calculator could be very useful. So this is GLD, same kind of deal, December expiration, credit call spread. In this case, it's telling us it's almost 30%, 28% of losing, and also the payout is completely different. So let's again do a quick calculation here. So it's 790, 210, and 28. So 790, 210, and 28. And obviously it's a bad trade, because for the fact I know in this case it has to come down to at least 21, which there's 7% difference compared to SPX. They were only 2%. So that becomes the question of, okay, is this a good setup to start with? If there's a 7% difference to start with, probably this is not a good setup. It's not a good risk to return ratio to start with. So I'm probably not even going to consider this trade. But some people might, because if they look at the chart and they say, well, there's a really strong probability, there's the economic data, this and that, and so that could skew the whole setup again. But again, looking at just simple mathematical way of looking at this whole setup, this really isn't a good setup compared to SPX. And if you do enough screening, actually I have come across to really good setup where the payout is the risk to return ratio is good, and on top of that, it's much better than flipping a coin. If I do this thousands of times, for sure I'm gonna win, even though in reality though there are other factors that come into play, right? Even though the setup might be perfect, that when you look at the chart, look at the economic data, whatnot. And this is also true when it comes to trading VXX or UVXY, where we know when you look at the chart, over time it's going to decrease because there's a contango factor. But when we look at the pure probability and setup and whatnot, it tells us it's not a good setup. But then again, does that mean I'm not going to trade it? No, I probably will trade it, even if the setup tells me it's not good. Well, in this case, it's 60. Let's see. Well, 30. Well, even that, yeah, it has to be payout of $40 in order for it to be 50%. But it's pretty close. So even though the setup tells me, well, it's not a good setup, but I know for a fact that there's a contango effect. It's always going to decrease. The price is always going to decrease if I set this up at the right time. At the right time being when it spike up. For sure, I'm going to be profitable, unless of course there's some kind of catastrophic event that makes it even spike even higher. So again, you need to consider all those factors. But the bottom line here is that this is why options trading is not exactly gambling. There's a risk, yes, for sure, but you are taking a calculated risk. Whereas when you go to casino, playing all those games, I mean, by default, you are going to lose if you do it thousands of times. And to spice this conversation up a little bit, there are people who trade stocks out there, and when it comes to trading stock, it's sort of, whether it goes up, it goes down, only two direction, right? Unlike trading options where there's time value, there's the volatility value, so that even this underlying stock price doesn't move, there's still possibility for you to make money. But let's talk about some of those trend following strategies, whatnot, and where their probability of losing is much higher, right? Probably up to 60-70%. But with those trend following, if you follow the right trend, okay, and if you if you see you are gonna lose, you set the stop lose very close, very little, make sure that you lose very small amount. In the long run, what that happens is that they are going to win a huge amount, right? Like say $800, whereas lose is going to be so small because they control it by doing stop lose one knot. So even though they lose 70% of the time, because their winning is so big compared to their losing, they ended up making money, because it's a good trade. So again, just because something has a higher probability of losing, if the payout is good, then you are more likely, you're most likely going to be profitable even under those kind of setup. So I just want to throw this idea out there for you so that you can see, okay, just because something is more likely to lose, or just because something is risky, doesn't necessarily mean it becomes a gambling. Because when you look at the number, when you look at the probability, by setting it up correctly, you can actually be profitable. So that's it for this video. If you like the video, give it a thumb up, follow the channel, and so that you'll get notification when I upload new videos, and I'll see you in the next video.